Good morning and welcome everyone to the Moneycontrol live stream. You're watching the opening bell and I'm your host Nickey Mirchandani. Well, Dalal Street looks set for a negative start after weaker than expected TCS numbers. Nifty futures on the Singapore exchange right now have been indicating a mildly negative start for Indian equities. Wall Street has closed lower yesterday after Fed minutes and inflation data. FOMC minutes predict recession fears due to the banking crisis. Asian stocks at this point of time, they've trimmed their losses on moderating inflation data in the US. FIIs, well, there has been the trend which is continuing to reversal of trend. There have been buyers, they've bought shares worth around 1,907 odd crore. In terms of DIIs, they've actually been on the selling side. They've sold shares worth around 225 odd crore on April 12th. Well, apart from TCS, which will obviously occupy a lot of mind space, and Infosys, where the eyes will be next on, there are a bunch of other companies which will be reporting their numbers, which includes the rise of Avantel, Rose Labs Finance, amongst a slew of others. Well, let us first discuss what TCS has done, what kind of impact that would have, and how will that actually resonate with the other IT names per se. If we talk about that, let's actually bring in the numbers first for you and 5 key takeaways which, will paint a broad picture of how the numbers have actually stacked up. Of course, it's been a weak show when you talk about the revenue profile, in terms of the expectation. There is both a margin as well as revenue mix versus expectation. If you talk about the constant currency revenue growth, now that's coming at 11-quarter low for the company. There is also sharp decline in net headcount addition. What also was concerning is there's going to be client spending which is coming wisely. Budget cuts, that's not percolated right now, but discretionary projects, they've been deferred. The good part was the solid order book, which I think was the bright spot in the entire earning, but attrition moderated, that was also a positive. Hiring has muted. Net additions, they've been slowed down a lot as compared to the previous financial year. So that was one of the factors which again was concerning. Through the course of the presser, there have been a couple of remarks which came through which I think were a little bit of concerns, especially from Rajesh Gopinathan, the outgoing CEO right now. He said that the quarter has been weaker than anticipated, primarily due to North America. Now, this has been the pain point. They've been expecting a comeback post-Christmas, which didn't happen. This was primarily because of North America saw the financial volatility in the banking system, and the CEO said that it's difficult to call out how long this will last. So North America has been the pain point, and that continues to be the concern. In this quarter, it was no different out there. Also, if you talk about JP Morgan, it's come up with a reference out there. It's maintained, the JP Morgan has maintained an underweight rating and the target price to an extent of 2,700 rupees per share. What it also says is the Q4 has missed estimates across the board from unexpected weakness in the US, that is especially the BFSI segment, and continued challenges in Europe. The outlook to an extent has been clouded by client caution, driving cuts to discretionary tech, spends, and project deferrals. With this, they've cut the revenue estimates by 1% and the margin profile by 20 basis points. That also is one point that you need to keep an eye out. Brokerages are also sensing that amount of gloominess out there. I wouldn't be really surprised if I see a negative opening coming in for TCS and a spillover effect on the other IT names. Infosys is up for numbers today. May post muted growth in Q4. There is a weak financial services demand, seasonality, all of that is expected to play out on the numbers. The company is likely to report a 1.4% quarter-on-quarter increase in revenue. So that's also one bit of development that is coming through. But in the studios, we've been joined by Santosh Nair, the editor, CNBC-TV18.com. Good morning there. What are you making out of TCS numbers in particular and the spillover effect that will have overall on the IT basket?
Well, hi, morning, Nickey. Now, if you look at the fourth quarter numbers, the market, something that the market had been worrying for a long time, that was mainly the fact that at some point demand is going to be hit. That finally seems to be coming true. So we're seeing some indications of that already in the fourth quarter number. And if you look at broadly the analyst commentary also, there are more brokers bearish to cautious on TCS at this point than there are those who are bullish. So see, much of the selling has happened in IT stocks. It's not as if market was very, very bullish, unlike last year when you saw a huge sell-off after the demand concerns first surfaced. So probably the sense I'm getting speaking to people in the market is that you could kind of see again IT stocks being range bound. You did see some kind of bargain buying which had come in when the stocks had fallen sharply a couple of months back. But at higher levels, very clearly, it looks doubtful whether investors will be very enthusiastic about IT stocks now that it's very evident that you could actually see tech spending come off a little bit because of the problems in US and Europe.
Yeah, that was also, Santosh, one of the comments that came in from Rajesh Gopinathan. He also said that they're going to be spending in very wisely, although there are no budget cuts per se which has happened, but there is a sense of caution, underlying caution, which is there. And also one of the comments, Santosh, we were just listening to the entire presser. At that point of time, they said that, at this point of time, you can't really compare the crisis that 2008 with this. There's a select banking crisis which have happened in US, and this is more of a sentimental impact as compared to a structural pain which typically is coming through for the IT sector. But do you think Infosys will kind of turn the table around for the players anytime soon, or it could be a little bit of game changer, or you expect Infosys also to kind of play along with the kind of trend that is expected in the quarter four for most of the IT companies?
Well, Nickey, if you look at broadly the performance of IT companies, there is not a very big variation in terms of the performance that these companies come out with. A little bit here and there, but not you don't have somebody doing 2% and somebody doing 10%. It's true. Always in a certain band. A lot depends on the subsequent price movement, then depends on how much the market was pricing in for those kind of expectations. So I don't think there's going to be a very big outperformance or underperformance from Infosys. And if you look at the entire tech basket, within the top tier stocks, probably I think Tech Mahindra is one stock which has been underperforming for a while. But if you look at the other three stocks, HCL Tech, TCS and Infosys, largely the performance has not been very, very divergent. So I don't think that is going to change with Infosys performance either.
Okay, Santosh, one of the point that I'd also want to highlight and probably chat about is the valuation picture. We've seen a steep correction coming in already for these large cap companies. Mid cap companies have also witnessed correction, but not to an extent that the large caps have, and because of which they continue to trade at premium to the larger counterparts. You think for mid caps, there's more pain in store now, as and when the earnings come out and the outlook is bleaker because of the vendor consolidation that will come through, and it's actually the larger caps which will kind of remain resilient to the sharp correction that they've undergone and the kind of pain that they've already reported in terms of their earnings and the commentary out there.
Well, Nickey, again, the general view in the market is that a lot of concerns about mid-cap IT companies. Now, typically, whenever the demand environment gets uncertain, investors tend to stick with the larger cap companies and they move away from mid-cap. So we did see one round of that happen when markets outlook towards tech stock turned bearish. So to a large extent, that's been priced in. What you could see from here on is that investors will be closely watching out for the commentary from these mid-cap companies. Now that most of them have corrected a fair bit, they'll be watching out for commentary. And I think you can't really club that entire mid-cap segment as one basket. Again, there will be pockets of outperformance. Unlike the top tier basket where more or less the performance is within a narrow range, in the mid-cap segment, what you typically see is that there's a wide divergence in performance. So it would be hard to paint them, or club them together as one. There will be pockets of outperformance and underperformance.
All right, Santosh, we're being joined by the technical analyst, the head of technical and derivative segment from Motilal Oswal. We have Chandan Taparia joining us right now. Good morning there.
Good morning. Thanks, Nickey.
All right. Chandan, I'm going to start off by asking you your assessment initially on the TCS number. And do you think with this, the 8 consecutive session bull run will now come to an end, or probably take a pause, if not not to an end? What is the strategy out there, and what are the immediate support and resistance levels that we can be looking at right now?
Yeah. So the Nifty index has been continuously making higher highs, higher lows from last 8 trading session, and already we have seen good run up of 900 to 1000 points recently, and especially 900 points in last 8 trading session. So overall trend is intact. However, some sort of consolidation could be there. The key level which we were watching was near to 17,777, and yesterday market is conquered near to the same. So some sort of consolidative move could be there, but I don't think there will be the change in the trend. I think some sort of the consolidation and the buy on decline could continue. So I believe that because of the heavyweights result from IT and now coming result from banking, some sort of consolidative move could be there, but we have to continue to be with buy on decline stance. As of now, I believe the 17,620 could act as a major support to extend this move to us further 18,000. So one need to do the lighter positions, but again continue to be with bullish stance. Now talking about TCS, the recently stock made bottom near to 3100 zone, but failing to surpass its 50-day exponential moving average. Call writing is intact. So I believe that support of 3100 could act as a key level, but at the same time we have multiple bottom near to 1460 marks. So I think multiple bottom near to 3270 kind of marks. So I believe that 3100 to 3270 is going to be range. Some dip could be there, but near to support again, some sort of buying interest could again emerge in the counter.
All right, Chandan, and also what's your strategy on Bank Nifty? Because we've seen some amount of outperformance. Quickly, the levels on that before we kind of address the market opening.
Yeah, so I think Bank Nifty also has done well, really. So some short covering was seen, and I believe with support of 41,250, 41,750, 42,000 levels could be watched. Buy on decline could continue here as well.
All right, so buy on decline is the strategy which has come through for banking index right now, Nifty Bank Index. And if we look at the market opening right now, we are looking at a negative start coming in for the markets, just in line with what the expectation was. 0.2% of loss out there. Bank Nifty also 0.2% of loss out there for Bank Nifty right now. A little bit of flat opening, but the one with negative bias. 0.1% of loss on Nifty Bank per se. If you talk about the other sectoral indices and how they've been stacking up in trade today, something like an auto, IT is down and out with losses of more than 1.5% on that one. If you talk about the other indices that we have, auto index holding up, the neck in green, more than 1%, 0.1% of gains seen on auto index right now, and metal index holding up flat with somewhat positive bias out there. If you talk about the other sectoral indices, something like a pharma also has been doing well. 0.2% of gains coming in on pharma index overall, and FMCG basket too has been holding up in green for you. In terms of the other sectoral indices, something like a realty, something like a infra index, a bit of a flattish with positive bias. 0.1% of gains coming in for infra. Realty holding flat right now. So it's like a very flattish sort of a day for most of the sectoral indices. We'd like to see what TCS has been doing ahead of what we see in terms of the Nifty gainers and losers out there. TCS down by 1%. So not really a very typically a sharp reaction, but we are seeing that amount of weak outlook weighing down on the stock performance of the company. Remains to be seen if negatives right now have been factored in and the stock can rebound from this level. But right now it's too early of a call right now. Let's look at the top gainers and the top losers out there. Nifty 50 top gainers and losers in terms of the advance and declines. 28 advances versus 20 declines. Market red right now still skewed in the favor of somewhat advances. M&M, ONGC, Sun Pharma. These are some of the top gainers that we have on our list. Apollo Hospital, Coal India, Eicher Motors. These are some of the other gainers that we have on our list out there. Goldman Sachs has initiated a report coming in on the Eicher Motors and Ashok Leyland. So I'm not really surprised with the kind of gaining the spotlight that auto counters companies are hogging at this point of time. Cipla, ITC and BPCL. These are some of the other gainers that we have on our list. And in terms of top losers, we have IndusInd Bank, HCL Tech, Infosys, basically IT basket dominating the losers list out there as the top loser. Tech Mahindra, TCS and Wipro. So Santosh, more losses coming in for IT sector, for the companies in specific. But auto, on the other hand, they've been, the names have been shining bright in trade. Goldman Sachs has initiated a report on Eicher Motors and also Ashok Leyland. What do you make out of it? And which sector, in terms of auto, do you see more recovery in store, given the kind of valuation for auto names right now?
Well, auto, again, the performance has been a bit mixed over the last 1 month. In fact, till about February, you saw auto being one of the best performers. But now, again, if you look at the commentary generally in terms of what brokers and analysts are saying, in fact, the bet now seems to be more on auto ancillaries at this point in time. See, the sales till March have been pretty good. Again, in terms of outlook on the economy, we are hearing mixed commentary. Some are saying that there is a slowdown coming, in which case, because of higher interest rates, clearly any sector that is sensitive to interest rate changes will be affected. We are already seeing that in reality right now, and probably those are the concerns at this point. Maybe that could be weighing on auto also. Auto also, let's not forget, it's largely discretionary spending, and that depends on the outlook on incomes and jobs. So if there's any uncertainty out there, which I think could be the only major headwind for this sector at this point in time, some of the other problems such as chip shortages, high input prices, those have come off. But now, as there's some concern about how economic growth is likely to be, I think you could see some kind of consolidation now set into auto stocks as well, because most of them have had a very good run up so far. Exception perhaps could be two-wheeler stocks, which have been already beaten down. So any signs of improvement in the rural market, that should really help two-wheeler, because these have anyway been underperformers for a while now. Whereas the commentary you're hearing from some of the brokers is that Goldman Sachs, for instance, you just mentioned it, it has rated Ashok Leyland as neutral. It's saying that the growth is now normalizing. Similar concern for Tata Motors was raised by JP Morgan, saying that commercial vehicle sales now should normalize. Last 2 years have been pretty good. So other than two-wheelers, I think so. This is again going by the overall commentary of brokers and analysts. Auto ancillary seems to be a better place to be in at this point.
All right, so auto ancillary seems to be a better place to be in, but we're going to quickly, Santosh, just hold on to the thought. We'll again come back to you and discuss a little bit more about the T-Tiger wagon and other stocks in play. But let's actually cut across to Chandan right now and get his view and perspective on auto names. Something like an Eicher Motor. Goldman Sachs has initiated a buy rating, Chandan, with a target price of around 3,660. It makes the cases that it's going to be the least risk as compared to the peers when it comes to the EV disruptions. There is a favorable margin dynamics. There is low sensitivity as compared to the motorcycles prevailing to the high interest rates. What do you make out of it? How does it look on the charts right now?
So selective auto, we have positive, including Eicher Motor or TVS Motor. If you talk, even Tata Motor also looks strong. So yes, I think this change in view will take the stock to higher levels. Will this upgrade can take the stock to higher level? So right now it's trading near to 3140. Any decline of 20-30 points could be the buying opportunity. We have support near to 3030. Stock can head towards 3250 to 3300 slow and steady.
All right, Chandan, apart from, Eicher Motors, is there anything else that, we can be looking at, something that looks attractive on the chart that our viewers can be looking at, which could be also profitable bet in markets like ours?
Yeah, so India Mart is one counter where we have seen significant long built up on the last trading session, and momentum is continuously seen in this stock. So I believe with support of 50 to 80, stock can head towards 5600 level. So one can focus here.
All right, Chandan, we'll leave it at that in that case. Thank you so much for taking out the time and speaking to us as always. All right, so we'll actually get into more discussion mode right now with Santosh, and we'll check with him his short calls and the bets that he talks about. Every morning there's this splendid piece that we have on our website, which is known as Short Call, where Santosh Nair typically puts out all the stocks that have been doing well, a little bit of insight of how they can further pan out their outlook, and basically your assessment of the pulse of the market, if I may so say. T-Tiger wagon is one of that you've mentioned in the list today, right? You've spoken about the stock making steadily new highs What do you make out of this and the entire basket which comes in for railway stocks, which have fallen out of favor when it comes to the investors?
So, if you look at the railway space, they were buzzing till some time back, but since December, if you see, most of the stocks have kind of they've either plateaued or are slowly coming off. There's profit booking that has set in. Titagar here seems to be some bit of is an exception here. The stock has really moved up sharply. The management was on CNBC TV 18 a couple of days back, and it said that main thing is that it's won an order for around 80 trains, and the government's plan is to roll out about 1,000 trains over the next 5 to 7 years, and Titagar clearly would be one of the major contenders for that, given its expertise in that space. But that said, one still has to see whether the earnings pick up, because that's one place where you've not been seeing a steady performance, which also partly explains the fact that the stock is still available at less than 2 times its market cap, less than 2 times its annual sales. So clearly here is something, there is seems to be a lot of faith among investors at this point, which probably explains why the stock has tripled in price, but we're still not seeing any institutional interest so far, despite railway capex being a major narrative. So that is something I would keep an eye out for.
All right, Santosh, I'd also want to resume our discussion that we were having on rate sensitives, because RBI has not gone ahead and taken that kind of rate hike that otherwise the street was anticipating, which was a bit of surprise move out there. And just in case, I'm not like preempting any kind of macros out here, but just in case if the interest rates remain at the place where they are, with no cuts, no hikes, just a stable move that we're looking at, if at all, then do you think real estate stocks could come back strongly with that kind of development, because they have already taken that kind of beating in the early part of the year? What's your assessment overall on that one?
Real estate, again, more than interest rates definitely is one part of it, but more than interest rates, what people tracking...
Demand. Pre-sales demand.
Not even pre-sales demand. I would say that it is based on the outlook on income. So typically, if the outlook on income earnings is good, I'm not saying earnings in terms of the company's earnings, that's always slightly tricky, given that it's very hard to decipher the earnings of the P&Ls of real estate companies. I'm saying in terms of individuals, for instance, salaried class, a lot depends on the outlook there. So if you see the weakness in some of the realty stocks, partly the sense I'm getting speaking to people in the market is that take for instance the IT sector. Clearly there are fears of job losses out there, and that is what is affecting to some extent the offtake for homes in a market like Bangalore. And I'm sure, given that the overall the outlook on the economy is a little cautious than what it was some months back, this is one area I think could consolidate for a while. Some of the stocks have seen a fair bit of run up. Many of them in fact have peaked out and have not been giving any meaningful returns, although again the commentary from each of these managements has been positive. So there is interest rates, which is one part of it, but more important than that, there is also some bit of concerns over the hiring scene at this point in time. So I think that would play a bigger role as far as home decisions are concerned.
All right, fair point. Santosh, I'd also want to address the energy companies right now, something in the likes of ONGC, Oil India, GAIL. These are some of the top picks that we have. Morgan Stanley has come up with a report, and it suggested few factors that are actually working in the favor. A benign energy price environment, improved domestic demand, significant policy tailwinds, better capital allocation, and a structural rise in dividends. These are some of the things that are actually working in the favor of companies like this. Morgan Stanley has gone ahead and upgraded Petronet LNG to equal weight. The target price has been raised to 235 rupees. So Petronet LNG is something that we need to keep a close eye out on. Apart from that, I'll also want to chat about one more initiation report which has come in overall on Ashok Leyland. That's an initiation report with neutral rating. The target price is to an extent of 140 per share. The brokerage believes that there is a fast growth in past 2 years that could normalize auto industry, which has entered into the mid-cycle phase in the commercial vehicle market. It expects a 25% EBITDA CAGR from FY23 to 26. And it's a couple of concerns like the cash drain from Switch EV entity could be one of the factors which could be weighing down overall with the sentiment. But Santosh, thank you so much for taking out the time and joining us.
My pleasure,
With
Nickey.
this, we completely run out on time on this edition of the show. And we're going to be calling it wrap and goodbye from the entire team who puts this piece together. Thank you so much for watching. Please do post your feedback for us in the comment section below. Follow us on the link at the bottom of your screen. For rest of the updates, stay tuned into moneycontrol.com and Moneycontrol app.